You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here. I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is real estate investment expert Chad Doty. Chad is the Chief Executive Officer of 37th Parallel Properties, a real estate investment firm that specializes in multifamily properties. With 12 years of multifamily real estate investing experience combined with 10 years of management consulting experience and close to $200 million in real estate transactions, Chad is a proven multifamily veteran. He currently oversees strategic partnerships, capital development, and platform development for 37th Parallel and its affiliate companies. 37th Parallel's portfolio consists of more than $325 million of assets under management spread amongst the Dallas-Fort Worth market, Houston, San Antonio, as well as a few properties located throughout North Carolina and Kentucky. And so in today's show, we're going to dive deep into Chad's business model and see what sets 37th Parallel apart from the others. Additionally, we're going to find out what the future holds for Chad's team and how they plan to maintain their growth over the next 5 and 10 years. So guys, I'm really excited to get on the show with Chad, but before we do, here's a quick word from our show sponsor, Sunrise Capital Investors. Hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche. And that's the phenomenal niche of mobile home park investing. For those that don't know, I've been a full-time real estate investor for nearly 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe you don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in our up-and-coming deals. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please go visit sunrisecapitalinvestors.com and click on the investors link to get signed up. It's absolutely free and you'll get placed on the priority list of when new opportunities come along. Also, feel free to call us at 833-CASH-FLOW without the O. Again, that's 833-CASH-FLOW without the O. And one of our investor relations team members will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule a call and let's get on the phone and talk. And with that, guys, I like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show. Now, without further ado, I'd like to welcome our guest for today's show, Chad Doty. Chad, how you doing today, my friend?
I'm outstanding. How about you?
I'm doing great. I appreciate you coming on the show here today on a Monday afternoon. I know Mondays are typically crazy, and so appreciate you taking time out of your busy day to join us here. And what I love, Chad, is that introduction I gave you was very brief. I know that it's probably much more expanded than that. Your background's much more significant. So if you could, for those that aren't familiar with you and your company, take a few minutes, fill in the gaps for me, fill in the voids of who you are, who 37 Parallel Properties is, and what your background looks like.
We started the company back in 2008. Prior to that, I bought my first apartment investment was a 6-unit historic building in Richmond, Virginia. And then was going to buy a 12-unit building and then was like, okay, wait, everyone I was talking to was like, you could spend the same amount of time and put capital together and buy bigger stuff. And I was like, yeah, that's a good idea. So then learned how to do that. But when I was in the consulting space, I did operations improvement and operational M&A in terms of making companies run better to sell or evaluate them to buy from technology process people. I wasn't a finance guy. I'm an operations guy. So even though I worked in the Big Five consulting space, it was sort of the business consulting side. So it created a little bit of a road warrior environment. And my wife and I waited about 10 years to have kids. But what it gave me, though, is I got to see the inside of very well and sometimes not very well run companies in diverse industries, 4 to 5 of them a year for years and years and years. So you learn very quickly to get a distillation of what works and what doesn't based on what you want to do from a business perspective. And what happened, everyone has these turning point moments, whether they seem like they're turning point moments, sometimes isn't evident to you, sort of like the Jobs quote, don't connect the dots until you look backwards. But when I was younger, my dad was in the Navy, birth to 7 or 8. And I grew up with him being gone for 3 to 6 months at a time. I never thought of it as a problem when I was a kid, but as an adult, having children, I didn't want those gaps. Yeah. Like, missing your child's first steps, their first baseball, their first goal, whatever these things are that, when they learn to read. So when I was in consulting, I was 4 hours away from my house in Virginia at a client. I'm in the boardroom with them, talking to the C-suite and talking to some project working on. I get a double call from my wife. I'm like, hey guys, I got to get this. Got a double tap. They're like, go outside. She tells me we're pregnant, and I'm not there to hug her. I've got to hop in a car, and I was like, okay, if I don't change this now, I'm going to be that guy and that I didn't want to be. So it was at that point that I started my own consultancy within 6 months, transitioned some clients, did that for probably 3 or 4 years. And then at some point you realize you're still just trading time for money. It's just you're your own boss and employee. Didn't want to scale it because there's no annuity revenue in the consulting space. You basically have to eat, you kill what you want to eat every single year, and you start at 0 and 1/1 of the new year. So wanted to, if I were to re-architect the business, okay, I want annuity revenue. I want it to be evergreen. I want it to be economic cycle bulletproof. And I want to know it could be here today along the evergreen cycle and for 20 years, 40 years, 60 years. And I'm okay with high barriers to entry. In fact, I don't mind that because you can solve for that if you're good enough. The low barrier to entry stuff, you got higher failure rates, you got a lot more noise. So I didn't grow up in real estate. I picked it. I didn't grow up in multifamily. I picked it. I didn't grow up in B-grade multifamily. I picked it. And that's because it had the features that I wanted. You guys do mobile and in your space, and you do it because it has the characteristics you want. I do this because the characteristics I want. But I don't think there's any right or wrong in real estate. There's a million ways to make $1 million doing it. It's all about the lifestyle, economic, whatever goals you have, because each one of them has their own flavors to it. Retail and office, you can make more money than God if you time it right. If you don't, you're going to give it back. Raw land, you have no control over the timing. Hospitality, when the economic cycle is good, you're printing money. When the economic cycle is bad, you're giving it back. It's just, when you look at the long-term trends, as typically resident occupied is more stable. It has lower peaks, but it also has higher valleys. So if you're looking to build an evergreen business you can trust all the time, that's what sort of pulled me to it. And there's tons more wrapped around why demographic cycles, jobs, nature of employment, the household income in the US is like 57, 58,000. That's the middle of the bell curve. Serve that group and serve it well, and you'll have a client for life.
Yeah.
So all that stuff is what sort of brought me to real estate. And then it was, okay, if you're going to build a business wrapped around it, what does it look like? How do you syndicate money? How do you take care of your client? Which you have two clients. You have a resident client and you have an investor client. You have to serve both well. But anyway, that's sort of some of the how we got to building the business. And then the rest was sort of business architecture 101 stuff.
Yeah, no, you bring up a good point. You mentioned that there's 1,000 or 1,000,000 different ways to make money in real estate. And that really is the case, right? There's no right or wrong. It's whatever is best aligned with you and your ultimate goal. And you just kind of outline why multifamily is a good fit for you and why you build a business around it. So with that being said, you'd mentioned that you started with, I believe it was a 6-unit property, right? Like that was kind of your first one. And I'm assuming you purchased that while you were doing the consulting gig. Is that when that occurred?
I was bridging in my consulting business until a year and a half into 37th Parallel. But yeah, the 6-unit building I found an asset I liked. I actually had an operations partner that I thought I could partner with. He had some other property. So he would be the property management side. I would be finance and strategy and debt. We'd run it together. That was the first lesson in picking your partnership, is a lot like picking a spouse. Don't think there's any short-term answer. That did not go well. Ended up sort of breaking even-ish on that deal, but learned some very important lessons that helped to mitigate some stuff down the road. But yeah.
I want to talk about the foundation. So that 6-unit was not necessarily the foundation, right? That might have been like the ladder, but like, the actual foundation, once it really got built, once you set in stone that you guys were going to syndicate larger properties. I want to talk about the first one, the first one that had some substantial size to it. And I want to kind of walk down your path that you took to learn that. I mean, this is a whole new business for you, right? Although you bought that 6-unit, in theory, you've done a lot of studying, you've talked to a lot of people in the space, but it's still theory at that point, right? I mean, you haven't really put it into action as far as raising capital, going out and actually deal sourcing larger multifamily properties. So talk to me about that first deal, what it was, how you found it, what that first process of syndicating capital looked like, challenges you've had. Just let's get the whole picture painted here, if we could. Right.
The first deal was $4.3 million, 112-unit building, B-C asset, built in 79, 80. It was with a partner who is no longer with the firm, that they had some prior experience in office and retail, but had never done multifamily. And I had some multifamily expertise, and I'm sort of grew up as a hyper learner. So, when you're in consulting, you've got to rapidly get to a level of competence that is ahead of your client from a value perspective. So I went from ground zero to really, really knowledgeable, just unpracticed quickly. But then it was just sort of putting that together with a trusted group. We bought the deal in 2009 when financing was starting to dry up, and it was an assumption. So it was basically a 60% LTV assumption. So we were bringing $2 million or so to close. And basically it was a combination of the two of us and our friends and family network to put that together. And we basically did a 506 or 505. And we did a 505 actually, because it was under 5 million. And then did that, went through that process, raised that money, closed the deal. And then that same seller was selling another project in that city. And we ended up buying, the next project was a 88 unit from the same one. But from putting the deal together to getting the syndication paperwork together, from the PPM and the offering materials, and it's all manual at that point. You have no systems. You're using Excel spreadsheets and Word docs and very tight internal organization to make that work. It's not, I'm not a big boil the ocean fan. So it's not like we had some massive CRM system, and we basically knew what the principles were, and we had good legal counsel, and we had good property management. We had a good team.
Yep.
And that's you talk about golden nuggets. I'm not going to say this is it, but one thing I'd offer is people mistake real estate and think it's a dirt business, and it's not. Real estate is a people business. Mm-hmm. And the team you have wrapped around you it's one of the biggest success factors.
Yeah, absolutely. Especially when you're playing this bigger game, right? I mean, if you're out there just buying a duplex here, duplex there, team, is it necessary? Probably not, right? But if you're out there buying hundreds or thousands of units of multifamily property, you're talking hundreds of millions of dollars of assets under management, completely different ball game. You can't run solo, or you can, but it's probably not the best decision. So, and the team is everything, right? It's either the making or breaking of your business model, either the right or the wrong team, right?
You're going to break on scale or quality or both.
Yeah, absolutely. So I want to talk a little bit about the timing. You guys got in 2009. I guess you didn't know what you didn't know at that point because you hadn't been in the game, you hadn't been syndicating, or you hadn't been a big operator in this space prior to the recession really taking hold. 2009, it was here, it was alive, it was well, and no one really knew what the bottom looked like. So talk to me a little bit about the decision to buy that property, how you swallowed that recession pill and got comfortable with the timing and ultimately what the future might or might not hold.
Yeah, I had a billionaire in our office. We were going through our capabilities and we talked about our timing. He's like, you guys were either geniuses or complete morons. I was like, it's a little bit of luck and let's just put that in the middle. He chuckled. A lot of people have this misconception that there is a national real estate market. And there's not. Mm-hmm. There really isn't. All real estate's local. The only thing that's really national is the finance market. But demographics are hyper-local. And so while you might look at what's happening to overall census level growth and the components of change from U.S. citizens to immigrants to children of immigrants to children of U.S. citizens and sort of where they go and what they do and how they behave and their psychographic preference to rent, all that stuff, that's a big picture. But really what you're looking at is population trends in the MSA and job trends in the MSA and diversification of jobs and diversification of population, migration, all that stuff. So we trusted the underlying tide. Mm-hmm. It's just that there was more friction to transact because sellers were less interested in not getting top dollar and buyers were like, no, I've got to get, pennies in the dollar or else it doesn't make sense. So if you look at the transaction volumes, they were easily 10% what they are today back in 9 and 10. And for us, it was just a combination of brute force, willingness to pay market for properties, knowing that market had been depressed because cap rates were higher and NOI was flat. And that's something else too, is B grade rents in the markets we were in didn't really dip. They just didn't grow as much. Mm-hmm. They sort of flatlined. So the nice thing is none of the sellers were in a position where they had to recover for something. They're just like, is it good timing for me? Because the people we were buying from were trying to 1031 into some bigger deals in some other markets. They weren't trying to optimize profitability. They were just individual sellers that needed to move the money around. That still worked.
Sure. And what market was that you bought that first property? Was that
It was in Texas, yeah.
Okay.
Yeah.
Okay. Got it. And you guys are based in Richmond. So that brings up the next question is quite a far ways from home. I don't know, what is that? That's probably 1,200 miles, if not more, I don't know, somewhere in that range.
I've never driven it. I'm only flying.
Yeah. Fair enough. But it's still far, right? It's a comfort level that a lot of people have a challenge getting over. And again, being that you guys were fairly new to the space, well, not fairly, you were new to the space. Mm-hmm. How'd you guys get over that hurdle of investing long distance?
Yeah. So from the time we started the business, we had a goal of hitting 500 million in assets under management. And we would actually be there today, but we had some pauses just in certain terms of sort of leadership reorg and some other stuff and people moving out some other items, but we're close. And so if you're building an enterprise that can, manage 500 million in assets under management, you're not necessarily needing to be hyper local, because I think there is a mistake. There is information bias that occurs when you feel like you have to buy in your backyard. Because if you ever talk to a broker that has a market, they're like, oh yeah, it's always a good time to buy and always a good time to sell, because they need that to happen because they live in their backyard.
Sure.
They're regionally tied. Where if you are looking to own nationally, what you do is, and internally we call it what's your MAC profile? That's market, approach, and capability. There are different ways to fix those variables. Some people, the independent variable is market. So, okay, we're only going to work in Atlanta. Okay, then you've got to say, okay, what is the market giving us in terms of what are the optimal approaches? Is it stick built ground up? Is it high rise in downtown? Is it renovate and keep? Is it renovate and sell? There's different micro strategies inside of an asset class. And then what is your capability? What are you good at? Either you yourself or the ability to partner with the get. And you've got to align all three of those things. Mm-hmm. For us, we wanted to be capability experts, which was B grade, moderate to long-term hold multifamily. Because then it's, okay, we can take that capability and just only work in those markets where that approach made sense and was profitable. So if that's your viewpoint, again, there's no right or wrong to those things.
Mm-hmm.
We believe it allows us to take our capability and go wherever it makes sense. We've got better buying opportunities and more longevity and less information bias or confirmation bias by doing so. Again, not saying we're right, I'm just saying that's our opinion. And so that then Texas dodged the bullet completely with regards to, not completely, for the most part, because they have a constitutional amendment that disallows you taking out more than 80% LTV on your home. So they put that in place from the S&L crisis in the early 80s, early to mid 80s. So that allowed them, think of it, all the negative AM loans, the 80-10-10s, the 90-10s, all those different weird, the no income or no doc loans, all those things that added 5 million extra homeowners that could walk into a loan officer and they put a mirror underneath their nose, and if it fogged up, they gave them a loan, right? That market just evaporated, and they all basically went back to live with family or to rent. Or if they go to live with family, they stay there until their family's sick of them, then they rent. And that flushed all that stuff back in the marketplace, plus you had growing population, all that stuff. So Texas absorbed an inordinate amount of some of that because they were still a stable location. Mm-hmm. And that's what gave them the jobs footprint going into how much they're booming right now. I mean, if you look at the top markets for job growth across the United States over the past 10 years, probably Houston, Dallas, San Antonio, or Austin, if not all four, are on that list.
Right. Yeah, absolutely. So
the Texas Triangle will have 50% of the entire Texas population will be in that triangle by like 2030, 2040.
So the Texas multifamily secret is out, though, right? I mean, everyone has been racing to get to Texas for the past 10 years. Since you guys started buying there. How is that affecting your buying opportunities today? And ultimately, is there still opportunities that you guys are uncovering, even though you've got now probably 100 times more competition than what you had back in 08 and 09 when you first started buying these properties?
No, I wish we'd been more capitalized, and because we're operations guys. We didn't come from, the finance shops in New York where, people don't work with you unless you're placing $20 million. We started putting together with 50 and 100K investors from the start, So I wish we'd been more capitalized then. Now we can take.
Don't we all?
Exactly. The competition varies by the tier you're buying at, but it's expanded in almost every tier, but the top tier, I think. So that sub 10 million, where you're going to have smaller syndications, single check writers, and that group, because the price per pound, the price per unit has gone up, they're buying smaller and smaller units. So they exist and there's still competition. I don't think it's that much worse, to tell you the truth, at that level, because there's a finite number of people in that area.
Sure.
Okay? It's not, those areas they're not capital formation centric, meaning that money has to get deployed. It's more like it's personal capital. So there's some just logistics constraints. Then the 10 to 20 million range, you've got more of the capital formation base, smaller equity groups, syndication groups, that sort of things. And you're definitely seeing more competition there. And that's driven down cap rates. But the thing is, the rent growth is still there. So while it's not as profitable, let's say it was if you bought back in 10, 11, 12, it's still very profitable compared to other hard assets and the soft asset market. So it's less profitable to prior years, but still profitable compared to the alternatives. So it's one of those sort of, it's not as much of an opportunity, but in our opinion, it's still a capital O.
Sure.
And what you're seeing in the marketplace. And then the 20 to 40 space has gotten more intense because that's where you've got people who need to write bigger checks. But it's the same rules apply. It's still comparatively better. And there's no one who's looking to buy every single opportunity. So you might see one person or one group looking to buy one kind of deal because of its zip code or its proximity to another deal or some other strategy piece, or they might be tapped on their economics. They're waiting to refill the kitty, So while the competition, it's not like there's 10 people at the door every single time. There's ebbs and flows. And then the sort of the institutional north of 40 million, that stuff, you'll see larger portfolio stuff, and they either package it up to 100 million or they go as singles and it doesn't have as much the institutional piece that we see. But that could just be our view of what we're seeing in the space.
Mm-hmm.
But it's one of those where I think it's more about, do you still trust the underlying demographics? If you still are looking at the data and you're not lying to yourself,
yep.
Then is your investor who invested 5 years ago willing to take slightly lower economics for the same asset class with the same forward-looking safety view? And if so, great, it still works. And we poll our clients twice a year to say, hey, here's what we're seeing. How do you feel about it? This is what our opinion is. This is what we've done in the past. And we've got a 100% profitable track record in our multifamily stuff. So it's useful just to say, hey, we look at this stuff like if we put our grandma's last $100,000 in the deal, would we be comfortable doing that? And we apply the same test, no matter who sees it. It's more, do you like the economic upside? And if you compare it, it still looks positive, but you could be different.
Yep. No, great points there. And you made a mention a few minutes back regarding where the source of capital came from for that first deal was, friends and family, pooled friends and family together to get that capital. After that, you guys really started looking for, higher net worth individuals, $50K a pop, $50K to $100K a pop. Is that ultimately who your investor is today still, or just accredited investors, higher net worth individuals? Or have you guys changed paths at any point in time, and have you sought out the more institutional path of money?
We've had institutional people knock on our doors starting in 2013. We haven't done it per se. I mean, we've gotten larger investors that have been able to demand maybe some slightly better economics on their side, but they've been more of business groups or family offices. In terms of the institutional, we haven't done what I would call a proper institutional deal. Mm-hmm. And primarily because it's expensive.
Yeah.
When you're a business owner, again, our opinion is that you should always be asking yourself, do you want to be big or do you want to be rich? And they're not always aligned.
Yep. Mm-hmm.
And so there are limits to how much you can grow and still maintain a certain level of profitability. If I can double in revenue and take a 20% profit margin hit, sure, I'll do that. Not infinitely, but I'll do that in some tier step. But if you're going to double your growth and double and half your income, why would you do that? Why would you add twice as much work for the same amount of money? So, and sometimes people just go big for the sake of going big and they regret it later.
It's more of an ego decision than anything else. No, I agree with that.
Yeah.
How about the actual management? I know that you probably have an asset manager or two in-house, but as far as the actual property management itself, have you guys gone with the model of outsourcing to third-party property management companies, or have you built that internal infrastructure in-house?
Yep. So when we started, we had two 505. I'm going to talk about the securitization side for a second and then talk about, because that also leads to how we modified our management. Mm-hmm. Our first two deals were 505 deals, sub 5 million. Then we did 506B. It was still friends and family. We just expanded that network and referrals and that sort of thing. And then we eventually switched to 506C, where we can advertise and can work with accredited only back in 14, 15. Basically, that came out with Dodd-Frank in 13 anyway. Mm-hmm. So while our minimum has always been 50, there's incentives we carry at 100K and 200K, and our average check size has generally gone up on every single deal. Because we've got some investors that'll do 100K deal, 200K deal, 500K a year, but they're typically, we look to target and work with and take care of a multi-allocation investor, that we're just not a one-time relationship. Yep. Because why go through all the time to build that relationship? It's just going to be one investment and go. Mm-hmm. And that's why we don't do crowdfunding. We don't believe in that model. It's just, you can only get $1 million from it, and you're working with $5,000, $10,000 checks. And a lot of times these people look at it like a stock, and it's a completely different product. And to us, that's a bug waiting for a windshield. I don't know your model, so I hope I'm not.
No, not at all. That's not our model. So yeah, no offense taken.
Yeah, I
like your analogies though. They're good. A bug waiting for a windshield. That's good.
It is. I think there's going to be a lot of people who are not prepared for what happens at a cash call. I didn't know that was possible. I've never had that occur with a stock. I want to sell it. You can't. It's a liquid. Right now, Fannie and Freddie are putting some material restrictions on deals that have a crowdfunded or crowdsourced component. So a lot of these marketplaces that are out there where you have people who go to the marketplace and pick a deal, they don't really have a relationship to the issuer. They have a relationship to the marketplace, and then they're picking the issuer like a commodity, which to the people that source these deals, like Fannie and Freddie, they are fantastically smart lenders. They haven't had a charge off in 3 years. And even during the downturn, at most, their distressed debt rate was 0.8%. Mm-hmm. They're smart people. And they're totally different. Commercial Fannie Freddie is totally different than residential Fannie Freddie with regards to how they manage. They lend out of a profit motive. They don't lend out of some housing obligation. So when they make decisions about the marketplace and risk, you better pay attention. Anyway, so from a management perspective, as we progressed through our model and scale, we started with third party because we had to scale it. But the way we buy is we don't buy and then pick a manager. When we actually buy markets. So we pick a state, then the MSA, then submarkets and neighborhoods. Then we look, okay, which areas do we like? Then we find management that works well within that MAC profile. That is good. Okay, are they CB managers? Are they A managers? Are they construction rent-up managers? So we find 1 to 2 top tier 20K units under management plus managers in that location, partner with them, and they're part of us through the buy cycle, and they're part of us through the cradle to grave. They don't have an equity stake, but because we want to be able to can them if they don't do a good job. But ultimately, they're our partner. Mm-hmm. And a novice mistake people make all the time is that they look at a deal on LoopNet, or they get on the listing for HFF or Marcus or whoever it is, right? And they look at it and they look at the numbers from the broker who's not a securities representative. They're selling dirt. And they go, this looks good. And then they go to get interested, and then confirmation bias kills them because now they only look for the things that make it positive for them to get that emotional pro forma, and pro forma is just Latin for lie. It's not, but we joke that
I know, that's good.
Right. I was just making sure the listeners.
I like these one-liners, man. Keep them coming. They're good.
Yeah. It's like I'm here all week, folks. Tip your waiter. But we wanted to have management that could carry our strategy. So it's always been third party, but it's not a national contract. We pick best of breed by location. Mm-hmm. That's how we do it. And we probably will not modify that until we can have 5,000 doors regionally, because what we find is property management, their profit margins are really low. Sure. Because they're making, let's say, 3 to 4% on gross collected. And then when you factor out their admin load of the regional property manager, the CPAs, all the accounting staff, everyone else, their net might be 1.5, 2. It's like grocery store margins. It's like a staffing company.
Yep, you're absolutely right.
So you have to pay for and have the infrastructure internally to push that staffing company. So a lot of people think, well, I've got a third-party property manager. They're not an asset manager. Mm-hmm. They're not. So we have internal asset managers, and we've got 2 on staff right now that came from Equity, Multifamily, Hunt, really large, good billion-dollar REIT level groups that want to be part of an entrepreneurial organization, sharing the profits, build a team, that sort of thing. It's how we do it. And then eventually, from a control perspective, we will either buy or build, but not till a little bit later in the process, just because there's, sometimes people think when they do it themselves, they're going to be better, but a lot of times they're not. And
that's ultimately not the case. Yeah, I mean, you got to think if a company's got 20,000 plus stores underneath management, they've been doing a lot longer than you. They've got the infrastructure in place, and they've been through the hiccups and banging their head against the wall and making mistakes along the way. So they're ultimately going to be better than those first-time investors that are just jumping into the space, taking on a large project that ultimately don't even know what to expect. And that's one of the luxuries that you guys have. I'm somewhat jealous of in the multifamily space that doesn't necessarily exist, at least not to the scale, even remotely to the scale in our space. There's just not a lot of professional third-party management companies. There's a handful, and I wouldn't even classify them as professional. There's maybe 1 or 2 that are of the scale of what you would find probably hundreds or thousands of in the multifamily space across the country. And so it's probably the most challenging part of our business, which is good and bad. It's good because it creates a barrier to entry from competitors getting in, because once you reach a certain scale, you hit this massive roadblock to where you have to make a decision. Do I build out an internal management company, which costs money? It's a losing endeavor. Right? Like you got to throw a bunch of capital at it before it ever becomes profitable, because like you said, the margins are uber thin. And never do I ever want to be in the the fee third party management business, because it's a necessary evil, at least on our side of the table, and there's just not enough profit there for us to ever consider doing it for someone else. And so kudos to the management companies that do it, but I would have no interest. I want to stay in the buy side and the ownership side.
You would only do it if it was a control based problem where you needed a level of control you couldn't buy.
Sure.
Yeah.
Sure.
And I didn't mention this, but when we started also, we had a parallel path where we bought cash flow homes, duplexes, tris, quads. And at one point in time, we had 100 of them. But the problem you're talking about absolutely exists in residential.
Absolutely.
There is. The property management in that space is so fragmented, and you do have national franchise partners, but they're just as bad. They just have a prettier logo.
Yeah, no, absolutely. I mean, I've owned hundreds of single family homes, had the same exact challenge. Just it's a complete cluster, and the professionalism that exists in those small residential management firms, it's subpar. I mean, it's not of the same caliber that you're going to get by working with a group like you guys are that have 20, 30, 40 or even more thousand doors underneath management. So in any event, I want to talk to you about the staffing of your company and how you guys ultimately scaled your group over the years, and what your team looks like today versus what it looked like in the beginning. How have you guys scaled as you've grown and taken more assets underneath management? What's that look like?
The way we do it is, it probably took us until about 4 years ago to have what I would call a self-driving leader in every core part of the ecosystem. So that's the struggle, is when you first start, when we first started as 2 people, then we added a executive assistant who is basically evolved into an office manager on steroids that does HR as well. She's employee number 1. But a business is a wheel, and you basically have to have a minimum set of spokes so that it actually rolls. And then you're basically adding spokes to get higher velocity. Then as you have enough of them, you can make the spokes longer and have a bigger wheel. Silly little analogy, but
another one. I love it.
Most people tend to get that because you think about, and
sure.
So for us, we've been fortunate in that we've been able to attract, because there's some people who just went on Get. I hounded one, like our investor relations director, who's a principal now. I hounded that guy for 4 years to join us. And he's helped us. And it wasn't a fit early on. He had other stuff going on. Eventually it was a fit. Another guy, Seek Us Out, who does sort of investor education and communication. He sought us out, became an investor, and eventually just was a real estate guy. And we just became really good friends. And he's fantastic what he does. We're an irreverent bunch of workaholics that believe in really, really strong meritocracy, but having a good time along the way. I'm wearing jeans and a button down. And I think the only time I wear a suit is when I go to like charity events, and I was suited out the entire prior life in the consulting space. So it's find good people and that want real estate and find a way to make it work. So building out those leadership groups is what creates scale for you. And the first time you do it, it's expensive. It's very rare, or let me put it this way. It's fantastic if you can. It was rare for us, where you can automatically fund leadership roles out of excess profits. What we've seen happen each time is we fund it where we basically take a dip in our takeout to find the right person, but then it lets us grow to the next tier of revenue and profitability at a much faster pace.
Yep.
Because we've offloaded not only our own capacity, but the ability for that piece to grow. And that's the part that's hard, because if you make a mistake and you think you've got someone who can grow that business and they can't, or they leave, that sucking noise it's painful. And that's just being a business owner. That's the part you've got to manage to, is that whack-a-mole that can sometimes be staff management. But to your specifically, we had an office manager first to offload some administration, or really an EA to offload administration. And then we added someone who helped us with asset management initially, and then moved into acquisitions. And we added another resource to run an education business line that we have in multifamily. We have a training group that does some stuff there. And then we added a technology resource because we had so much going on with regards to digitizing our offerings, a CRM system, what have you. Then we went to full-blown asset management. Then we added an acquisitions analyst, another asset manager, investor relations. So, I mean, right now we're 13 people But the thing is, I don't have to touch my staff now for the next 2 years, and I can grow to 500 million to 600 million AUM. But so we maybe hit that leadership team, like I said, 3 years ago. But our growth since then has been fantastic. We're Inc. 5,000 4 years in a row. So
that's fantastic. I mean, so really what you just said there, and to sum up in a nutshell, as far as making a decision to hire those internal leadership roles and just the general staff to oversee your businesses, you're essentially taking a step back yourself personally. I mean, you're setting aside potential profits or income on your side, and it's a big risk. But ultimately, in order to scale and to grow that company, you've got to be willing to accept that delayed gratification pill. You have to, if you want to grow the business to a certain size. Otherwise, you're going to be that guy that is wearing all the hats that ultimately feels like he doesn't want to give up any control, and never, to a certain point, he never grows, right? I mean, he hit that barrier and just never can step past that barrier, can never make it to the next level. So no, we're in the same path. We're probably about 70% of what you just explained. We're about 70% through that path. We've got a couple of leadership roles already hired, and probably where you were today, we're probably, I guess, or I'm sorry, in about 2 years or about a year and a half, 2 years, we're probably where you guys are today as far as our internal operations and who we have on staff and who we're ultimately looking to hire. So it's exciting, though. I mean, it's amazing once you bring talent in. It's amazing the turbo boost or the supercharge that it gives the organization. It just bringing not just that body in house, but that additional life and the raw talent and the enthusiasm. Once you actually start multiplying that enthusiasm from you and your partner to another person, to a fourth person, to a fifth person, and everyone's really very much aligned in their interest, and they're all charging in the same direction. It's amazing what could be accomplished. So I want to talk to you a little bit about, and we're running out of time, so I want to be respectful of your time here. But as far as aligned interest with your staff, you had mentioned very briefly in the beginning, I don't know if you necessarily didn't call it profit sharing, but you said something along the lines of allowing your staff to participate in profits or in maybe the equity. I forget exactly how you worded it, but do you have a profit sharing model structured within your organization? If so, and you can say no to this, but are you open to sharing maybe just a high level view of what that might look like?
I'll provide some snippets on it.
Yeah, fair enough.
I'm a little bit of a skeptic on a few things, but there's the rah-rah study work out there that people they're not motivated by raises. And on a large scale basis, whether it's 5 levels of appreciation in the workplace, or it's, depending what they're, because there's, the guy who did love languages, the 5 love languages.
Yeah.
They did that for the 5 languages of appreciation in the workplace, what people need to hear to feel. And that's it. It is important, but it is not as a really, really, really good A player is going to understand the value they bring to the marketplace. So you do not want to nickel and dime that person. You have to do the other stuff too, but their value to the organization in salary and profit sharing, if they're that level of player, is going to be 3x, 10x, 100x their cost.
Mm-hmm.
So finding out where the market is, understanding if they were to go look and get an offer, okay, where's the market sit? Okay, what do you need to do to be slightly above market to just get initial retention? And what can you do to make it where you help scratch that entrepreneurial itch without them taking the risk of starting everything on their own?
Yep.
So what is it you can do from a profit sharing, from a 401k structure? Like, it's funny, we're not stock people, but we offer it just because people expect it.
Sure.
So, okay, do what you want.
We're the same way.
Yeah, we and we dump, most of our stuff is we take guaranteed payments to partners. That's not minor, but we still max a 401k, because what else are we going to do with it? When we stick it in like super conservative funds, it just won't go down. Mm-hmm. But we don't need the tax savings because of the depreciation. But anyway, you create those mechanisms. And then we've created a mechanism where our staff at different tiers and different years of service can get equity in our deals. It's like we're sharing future carried interest in deals. So our investors know that all the staff that work on their deals get a slice of those future profits. We as the owners are giving up our slices of future profits to those people. So the entire company is aligned on performing for the investor client and the resident. By doing so, it's not just, did the company hit its numbers? No, it's these deals have to hit their numbers too. And that percolates down to the lowest level employee.
Yep, got it.
And so that there are different ways to structure that, but I offer that as a paradigm to think about if you're in the real estate asset class and you have some level of promote built into your economics.
How do you handle that as far as like down the road? Ultimately, should some of these folks leave after they've already been, vested in a few or multiple deals? Does that stick with them? Do they take that with them, or does that essentially go away if they've chosen to leave the organization?
No, we keep it super simple. If they've earned it to begin with, it's theirs. Now, but it's still dependent on the performance of the deal.
Yep.
But it's not some weird vesting schedule. And we've had other asset managers like, you should do this. I'm like, nope, it's super simple. They have other vesting structures too that create more current money, but this is nope. It's just an allocation, and whatever the size is, they can't sell it. It has no market value. They've no control. Whatever it delivers to them, it delivers. But they know they can understand what it's worth at any time, and we've got clear reporting to them if they ever want to know what it is.
Got it. Well, that's awesome.
It's just easier that way.
Yeah, you got to keep it simple. I mean, if it takes you more than a couple of minutes to explain what they're going to make on a particular deal, what their compensation might look like in the long run on a deal or deals, then it's too complicated, right? I know you love acronyms and analogies, so KISS, right? Keep it simple, stupid.
Right.
In any event, Chad, this has been awesome. I really appreciate your time today. And what I'd like to do now is enter into what I call the Golden Nugget segment of the show. And this is where we're going to also work to wrap things up here. So I'd like to ask of you, you've already shared a lot of gold nuggets here on the show today, but if you had just one last final nugget of advice or wisdom that you could leave with the listeners today that may inspire and motivate them as they progress in their real estate investing career, what would that one last gold nugget be?
Can I give two?
Yeah, absolutely. You can give as many as you'd like, my friend.
All right. So the first one is once a year, read a book called The Goal by Eli Goldratt.
Okay.
And it's about the theory of constraints. And it was written from the perspective, he's sort of like the godfather of lean manufacturing, or I think the precursor to it. And the idea was you don't improve a business environment by increasing sales or more inventory or whatever. It's looking at knowing enough about your business environment to find out where is your constraint, where is the bottleneck. Mm-hmm. It sounds like common sense, but it's not common practice. And if you just look at what is slowing you down and you fix that first, don't look at anything else, because once you fix that throughput problem, something else will show up you didn't know about. Analyze that, fix that. If you look at your business through that lens, it's almost impossible to fail because you'll always be looking at the right thing, the constraint. But you have to be brutally honest about the fix. If it's you, or if it's you're not bringing enough capital in or not doing a good enough job, it'll be obvious. But that process alone has helped us as owners always be focused on the right thing, we believe, again. So that's a process I would offer as a golden nugget. Read the goal once a year. And then from a business perspective is know your asset class so well, like in your bones. A lot of people, I think they look at a pro forma and they feel like, okay, I'm going to move NOI here and it's going to create X ripple. You should know your model so well, you intuitively can understand small permutations in the variables to understand at a gut level what will happen to it. Because when you're at that level, you can explain it to your grandma, you can explain it to a Wall Street investor, you know it in your bones. And for you to go out and look someone in the eye and ask for them to give you $100,000, $200,000, $1 million, $10 million, you have to know it in your bones. You have to understand what can affect it positively, negatively, and you have to know it cold. And if you don't, you have no business doing it. So the rush out and get money, no. Money flows to people that know what they're doing. Money doesn't flow to good deals. Be that person who knows what they're doing.
I love it. I love every bit of it. And there was also, before we started recording, Chad, you mentioned also about an ebook or a digital audio download or some sort that you'd like to offer the listener. So I want to make sure that we get that out and don't forget about that before we wrap up the show today.
Yeah, no, thank you. Dennis Bethel, Dr. Dennis Bethel, he does investor education for us. And in the medical field, there's a term called evidence-based medicine. And the concept is you only implement those methodologies that drive better and better patient outcomes, period. And the evidence must prove it out. You can't be bro science, can't be something you read on the internet. It has to be something that over serious clinical trials has been proven to be effective. He took that lens and applied it to real estate. And he's like, why am I here? Why do I like real estate so much? Why do I like apartment buildings? And he built it out of here is our process. So it's a booklet called Evidence-Based Investing. It's like 35 odd pages, but it takes the concept of evidence-based medicine into the investing world. And it's not a commercial on 37th. It's why we like commercial multifamily. Here's all the third-party data we believe is relevant. Take a look, consume at your own pace. If you believe as we do, great, join us or join with somebody else. But either way, it's a nice consumable on why in the space that's based on real long-term data.
Okay, fantastic, guys. I'm going to actually put that in the show notes as well, link to that so you can download it and dig through it. So that sounds awesome. I really appreciate you coming to the show. It sounds like you guys are doing awesome things over there at 37th Parallel, and looking forward to following your success. And you guys are on your way to that. You had that $500 million asset under management goal, and you guys are almost there. I mean, you're really close. So I'm guessing in the next 12 to 18 months, you'll probably reach that goal. Is that ultimately what you think will happen?
We should. Yeah, we're 415 million transaction volume, depending on if we get some opportunistic sales, it may slow down, but otherwise we should hit it in the next 24 months or less.
Yeah. Well, fantastic. And folks, if you want to learn more about Chad and his company, you can go visit their website. It's 37parallel.com. Again, that's 37, like the number 37parallel.com. And Chad, that's all we have today, my friend. Really appreciate you coming on here and keep doing what you're doing. And we'll talk again soon. Okay.
Thanks, Kev. And all the success to you too.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.